Welcome to Finance for World. Today's explainer unpacks the profound interconnectedness of this weekend's news, showing you exactly how global crises are rippling directly into your investments right now. We're living in a moment where, honestly, a headline from the other side of the planet can literally dictate the value of your retirement account before the market even opens. So how exactly is this global conflict driving your portfolio? Well, we're going to explore the ultimate tug of war happening in the markets today. As an investor, you're probably feeling pretty torn right now, and for good reason. Markets are caught in this massive struggle between some optimistic diplomatic breakthroughs on the global stage and, well, some increasingly pessimistic macroeconomic realities here at home. To make sense of all the noise, here's our agenda. We'll hit geopolitical flashpoints, then inflation and oil shocks, look at how the Fed shifts its policy path, dive into global market reactions, and wrap up with regional finance moves. Let's jump right in. Starting with Section 1, Geopolitical Flashpoints, the spark. Before we zoom in on the market impacts, we've got to acknowledge the broader backdrop of global volatility right now. We're seeing sudden domestic security incidents like the fatal shooting of suspect Nasir Best near a White House checkpoint, right alongside news that the Justice Department scrubbed January 6th releases from its website. And overseas, the environment is just as fraught. Russia just used a hypersonic Orizhnik missile in an attack on Kyiv, and a tragic suicide bombing near a railway in Pakistan killed at least 23 people. It's a whole lot to process at once. But, amidst all this tension, there's a massive glimmer of hope. Over the weekend, President Trump stated that a deal regarding the war with Iran, crucially, this includes reopening the Strait of Hormuz, is, in his words, largely negotiated. He described it as a memorandum of understanding pertaining to peace. And man, that single headline injected a huge dose of hope right into the global markets. Moving on to Section 2, Inflation and Oil Shocks, the macro middle. Now, peace hopes are great, absolutely. But the economic damage from recent conflicts is already in the pipeline. It brilliantly illustrates the domino effect in action. Think back to late February. The U.S. and Israel attack on Iran effectively closed the Strait of Hormuz. That military disruption blocked crucial oil exports. And the direct result of that? By April, the U.S. Consumer Price Index surged 3.8% year-on-year. That's the largest jump we've seen since 2023. And flowing right into May, we're seeing gasoline prices continuing to spike. The conflict literally pumped up the prices at your local gas station. As you can see from consensus forecasts, inflation concerns are continuing to flare well above the Federal Reserve's 2% target. Because of this, all eyes are turning to Thursday's personal consumption expenditures reading. That's essentially the specific inflation gauge the Fed cares about most. The whole market is just holding its breath right now. Which brings us to Section 3, Fed shifts policy path, monetary whiplash. Over the weekend, Kevin Warsh was officially sworn in as the 17th Federal Reserve Chairman. And wow, he is stepping into an incredibly complex tug of war. In the past, Warsh has been pretty critical of the central bank for not lowering rates enough. But now, he faces public demands from the president for immediate rate cuts, all while the administration simultaneously states Warsh should act with total independence. It's a super high-pressure environment for the new chair. However, the hard economic data is forcing a distinctly hawkish shift. Fed Governor Christopher Waller bluntly signaled that patience is required, and actually, the next rate move is just as likely to be an increase as it is a cut. Because of this across-the-board hawkish stance, interest rate swaps are now fully pricing in a 25 basis point rate increase by late 2026. In plain English, Wall Street is betting that borrowing money is about to get more expensive, not cheaper. This sudden reversal in expectations completely halted the recent Treasury market rally. Let's look at Section 4, Global Market Reactions, the ultimate tug of war. We saw absolute whiplash in emerging markets this past week. Initially, these markets rallied hard on the news that the U.S. and Iran were moving toward a peace deal. It was a clear risk-on environment. But then, by Friday, as a global sell-off took hold due to those exact fears of rising central bank interest rates we just talked about, emerging market assets tumbled right back down. It is literally a day-by-day battle between diplomacy and inflation. To really anchor this abstract fear in hard data, just look at this number. The 30-year U.S. Treasury yield skyrocketed to 5.21% on Wednesday. That's a massive milestone. It marks the highest borrowing cost we've seen since 2007. And when risk-free rates get this high, it completely changes the entire calculus for investors worldwide, making those safer bets look incredibly attractive. Because of those soaring multi-decade high yields, investors abruptly shifted their risk appetite.
This triggered a massive withdrawal of $6.13 billion from global equity funds in a single week. That sudden outflow completely snapped an 8-week buying streak. The smart money is clearly out there recalibrating its exposure to risk.
Strangely enough, though, amidst this flight to safety, we're seeing a red-hot rally in junk debt. Essentially, investors are sort of financial dumpster diving right now, chasing these riskier, lower-rated notes just to grab juicier yields to cushion the broader bond sell-off. As a result, high-yield credit spreads are near 2-decade lows, and junk debt is actually outperforming investment-grade bonds by 1.6 percentage points. It's just a fascinating anomaly in what's otherwise a pretty fearful market. Finally, Section 5. Regional Finance Moves Strategic Positioning. Everyone globally is scrambling to adjust to this new localized macro reality. The IMF is warning the EU they might actually need joint debt to fund defense, or they'll face debt hitting 130% of GDP by 2040. Over in the Middle East, Qatar is expanding public-private partnerships just to ensure food security against supply chain shocks. Here in North America, major U.S. banks are betting against the Canadian dollar because Canada's inflation is relatively tame. And in Europe, Investec is seeking an Irish banking license to secure a foothold in that massive $45 trillion EU market post-Brexit. Everybody's making moves. Yet despite all of this, the surging oil prices, the ongoing geopolitical conflict, and spiking bond yields, the stock market is showing incredible stubbornness. The S&P 500 remarkably remains less than 1% below its all-time high. How is that possible? Well, it's largely being buoyed by a blowout corporate earnings season. Companies have delivered, allowing investors to just temporarily look past the macroeconomic storm clouds gathering on the horizon. So, as we wrap up this explainer, the ultimate question for your portfolio is this: can diplomatic breakthroughs and strong corporate earnings outrun the compounding pressures of global inflation? The answer to that is going to define your wealth trajectory for the rest of 2026. Thanks for joining me today, and make sure you keep your eyes on the data.